Hey everyone, welcome to News of the Money World. My name is Darcy, and your name is Rupert. How are you, Rupert?
It
Good?
is today.
It is today. It's good just to remind ourselves because it can get
Yeah. At
confusing.
times, I don't know what my name is. I don't know what day of the week is. I mean, on
Yeah,
a good day, I can't even get my children's names right. On a bad day, I can't get mine right.
that's right. That's good, man. Okay. Well, maybe that is a fitting enough introduction to what we're talking about right now, where we kind of just don't even know what's what at the moment when you kind of read articles like you might find in Bloomberg or the Herald here in New Zealand, or you listen to a few podcasts. Feels kind of like we're in this weird sort of neutral middle zone plateau where people are kind of just running out of stuff to say. It's kind of what it feels like. Would that be your impression? Like, what would be your general lay of the land when you? Because I know you're into reading a whole bunch of stuff as well. So, what's your kind of general take with what's going on in
Look,
markets right now?
100%. I mean, I was sitting down yesterday going, well, what can Darcy and I talk about tomorrow? Doing some prep, which is probably where I went wrong. But yeah, it's kind of just feels as though the conversation's getting a little bit boring at the moment, and the conversation is just rinse and repeat. It's kind of where are we at today on inflation? Where are we at today on economic data? Where are we at? What does that mean for interest rates? What does that mean for economic data for equity markets?
Mm.
Is good news bad news, or is bad news good news, or is bad news bad news? It's kind of like I don't know. For me personally, it feels as though we're in this kind of reactive cycle and it's all mixing and matching and being a little bit the same. So that's where I think, well, let's unpick some of that and maybe we make it slightly more in depth than what we're used to and go actually have a real conversation around why are we where we are and why is
That's
the
good.
market kind of sitting there at all-time highs and is that sustainable?
Yeah,
Is that a good idea?
it's a fantastic idea. So it's a bit of a not navel gazing, but it's more like intellectual gazing. It's more like reflecting on
Yeah.
what's what. Okay, no, that sounds good because like I've got a few things that I have been watching, and you've mentioned before already. Like markets are up 30%. It feels like there's this increasing disconnect between Wall Street and Main Street. I'd go further and say there's a big disconnect between Wall Street, Main Street, and the fourth estate, like media.
Yep.
And it
100%.
feels, especially like with media, and I guess this is what you're probably picking up as well. It's like this. It's kind of like hallucinations, as in AI hallucinations. Like we've got, it's either going up or down. We have success, but it's only happening with the Magnificent Seven. We have the inflation story, which is like on a leash with interest rates, but we don't know whether or not the actions of regulators, Federal Reserve specifically, is going to actually control the market or not, whether that's just smoke screens, tail wagging the dog wagging the tail. So one of the things though that I find quite interesting is just on the media side, because like we are at the, like there's Bloomberg and then there's us in terms of like quality, right? Like we are there in terms of,
Herald's not high quality in-depth analysis.
well, I think we've got so much more to offer, Rupert. I do. We're just waiting to be discovered.
Exactly.
So, but yeah, it does feel kind of like the snake is eating the tail on the opposite side type situation, and maybe it's just another confirmation that we don't really know what markets are doing. And I guess when you think about the financial services industry, or you think about just the investment industry, because it is an industry, you recognize pretty quickly that there is a certain tendency to pay to play or pay to get your message out there. And this is where you have the PR agencies, marketing firms, the advertising spend, and you're trying to get your message out there. So you're cherry picking the data that you really want to push forward because that advances your cause or that advances your style of investments. And it creates this tribalism, which feeds already into this populist way of thinking, where we, instead of thinking for ourselves, we rather just join a group
Yeah.
and engage with their group thing rather than engage with our intellect. And I think as we see that happening, to me, that does actually feel like genuine risk because that possibility is growing larger that should a market correction happen, we'll have no idea that it's coming because we've drunk the Kool-Aid, right? And we've tied ourselves to that mast irrespective of where it's going. What do you think?
Yeah, I think you've raised two or three really, really interesting and important points here, right? So I think there are two things I think that we need to kind of recognize, right? First and foremost, negativity sells. And we've talked about this in the past. And I remember we did an episode on this like 18 months ago, 2 years ago. Research has shown consistently that negative news headlines generate far more interest than positive news headlines. And so therefore we find the media is often skewed to the negative. So that's kind of point number one. Point number two, most experts in this space, and particularly have a bias, right? And have something to say. So they kind of, and you've also got to remember what you're trying to do, right? If you're an economist that wants to appear in the headlines, you've got to say something out there, because if you don't say something out there and you're not willing to kind of pin your mask to an out there prediction, newspaper doesn't want to speak to you. And coming back to kind of what we've just said, in the current environment, it's easier to be negative than positive. So that's kind of why I think economists are largely there. And we've found over the last 2 years, economists have been far, far, far too negative on the impacts and have consistently been upgrading their perspectives. The third piece that's really, really important to recognize as well is when it comes to the stock market, the people that are giving you the information, the predictions, the forecasts on the stock market are generally either fund managers or stockbrokers. Well, it's kind of old school word, but they work for firms that sell shares. And let's be honest, it's much easier to sell shares and people are much more likely to buy stuff when things are positive and things are upbeat. And so I do firmly believe that people go into this with the right kind of the right intentions and they honestly believe what they're printing. But there is no question that everyone is writing the research and providing the analysis that also helps their business. Because at the end of the day, there is no such thing as impartiality. And I think that's kind of one of the big things that we need to kind of reflect on. And probably, I said there 2, but now I'm up to 4. My fourth big one would be, look, in New Zealand, we need to remember the New Zealand economy and where we are kind of domestically is actually pretty sick compared to the rest of the world. Our economy and our market is in much worse shape than many other parts of the world. And so therefore, we can't reflect on what we read about here in New Zealand and go, that's kind of what's happening in the markets and that's what's happening in my KiwiSaver, because actually New Zealand makes up less than 1% or 0.5% of global stock markets. And for most people in their KiwiSaver, New Zealand equities make up anywhere between kind of 20 to 25% of their equity portfolio inside their KiwiSaver. So there's quite a few disconnects here that we just need to be aware of as we're kind of reading and as we're going through it all, right? And so that, to me, kind of, when you put that lens on it, it makes it a whole lot easier to understand, right? Because, as you say, markets are up 30%, markets are trading at all-time highs, yet we've got kind of a S&P 500 currently trading at a 21 times forward-looking PE versus a long-term average closer to 16 times, yet at the same time, most of the world's largest economies are either in or skirting recession, and we've got unemployment rising throughout the world. So, what's that dichotomy? But I think what we have to do is now look at the underlying companies to understand why. And you said the exact right thing around divergence between Main Street and Wall Street.
Yeah, no, I agree. And it's, I guess you see this at the micro level, right? Like what you're saying is your own individual perspective, your subjective perspective can cause you to draw conclusions around the next sphere out. So if you're a negative person, you're going to have negative friends. If you have negative friends, you're probably living in a negative country. Maybe, I don't know. And maybe the world is negative, maybe it isn't. And you've kind of just talked yourself into a big, massive hole and everybody else is just killing it and they're having a great time, right? Like that is a definite possibility. And I guess when you see the evidence of Main Street, which is just the real everyday economy, diverging from Wall Street, the financialized world of ownership, of equity in those companies, when you see that divergence growing, you can make that assumption that, hey, if stock markets are at all-time highs, then that means things must be economically really good. So if I'm struggling financially to make ends meet, I have a bit of job insecurity going on, then something's wrong with me. But in reality, you've kind of seen this flippening, right? Where this top 1% is just getting fatter and fatter and fatter at the expense, to a certain extent, of the middle and lower class. And I'm speaking primarily to what seems to be happening in the US, but I know that's also playing out in places like Australia and New Zealand, and probably the UK as well, Canada for sure, where there feels like borders are disappearing, and the people that were already there are now thinking about, well, where else can we go? Because it doesn't feel like we belong in this place anymore. So there is this, this micro headset way of looking at it. And then when you zoom out and you look at this from a much bigger perspective, this is where it starts to get fused with a growing mistrust or distrust with legacy institutions, nation state authority. There's a growing, I guess, education going on, which is good, but it's also dangerous, around how the dollar, the fiat currency, how the dollar system works, which is starting to fuel a little bit of a rebellion I can see happening, which I find quite interesting as it relates to what we're saying around negativity, because it feeds that negative thinking, which is really powerful, right? But it's going to come to a head at some stage. Either the revolution will not be televised, but it will happen, and it'll happen and it'll be gone, and then they're squashed, those people that were, raging against the machine, or it will affect us in some way. And what I'm alluding to is just like this loss of confidence in the share market from the next generation of investors, i.e. exit liquidity, depending on how cynical you want to get. So do you feel like this growing risk of market correction is actually increasing because of what I just said there around this growing distrust?
I don't know. I think I do. I 100% agree with what you're saying on the distrust. I 100% agree with the rich, the rich is the wrong word, but we are back into a world of the oligopolies. There's no question on it, right? You look at what's happened in the last 3 years. Why are markets trading at all-time highs? Markets are all-time high. It's kind of earnings are growing at 10% a year, right? How do earnings grow at 10% a year when you're in a recession? We've got margins have never been higher. We've got return on equity, which has never been higher. All of these underlying components of companies are showing that actually corporates, and particularly those very large corporates, are stronger than they have ever been, which I think is because what we've seen, the technology was meant to be the big equalizer, and it was meant to be the thing that brought everyone back together. But effectively, what I personally think we are starting to see is technology is kind of is putting wealth in the hands of a few versus the hands of absolutely everyone. And I think AI is going to be the next stage in all of this, because for AI to succeed and be really, really good at AI, I mean, you need massive data sets, you need massive computing power, and neither of those are easy or cheap. I mean, something I was listening to last night talked about how Apple and Google are now having to team up because they think that's the only way that they're going to be able to take on Microsoft in the AI space. And so when you've got like companies number 5 and 6 of largest, 3 and 6, the largest in the world, having to team up to beat kind of the person that's number 1, you're going to go, fuck, that's a scary thought. So a really long way of answering your question is the size and scale in this oligopolistic world that we are in my mind, is what's driving the stock market. But actually that might also protect us from a crash, because at the end of the day, the only thing that's kind of, or in my view, the two things that might kind of transform and change that are either rapid technological change and innovation, and AI kind of is that, but AI is almost entrenching the status quo versus doing anything different, or it's going to be regulatory change. And actually, do I see regulatory change coming anytime soon? No way. I mean, there was a great article on Elon Musk, I don't know if you read it, in the weekend, where it's talking about how his new kind of approach to the world is basically he goes and becomes best friends with every single authoritarian leader so he can get the most out of them. The day after the Argentinian president was elected, he was tweeting on X about how great he was, how he's going to completely transform Argentina, and it was the best thing that ever happened. And of course, 3 months later, he's got himself a new lithium deal. In China, he's doing similar things, and now he's got self-drive. In India, he's talking about Modi being the greatest politician and the greatest person to ever drive people out of wealth. And now what's he got? He's got tariff-free access into India. So, yeah, I do believe we are a little bit back to the future into this kind of oligopolistic or even monopolistic world. But how do I see it coming to a quick end? Not really, which kind of means I'm probably more confident in markets because of that. But do I think that's good for society? No. And I'm just not. I agree with everything that you're saying on the discontent, but how does it manifest?
And that's ultimately the question, right? How does it manifest? Because if I think about a similar time in history, sort of, and I say sort of quite deliberately because there's a lot of parallels here, but I'm not quite sold on it, is the 1970s.
Yep.
So my first car was a 1971 piece of crap, right? So that's what I was driving as my first car. So I remember doing research around this vehicle when I bought it, like a long time ago. When I bought this thing, I kind of did a lot of research around that. It led me down a bit of a rabbit hole around investigating the music, investigating the culture, investigating like all of the stuff that was happening around the early 70s. And it kind of felt similar in a way that they didn't really know what was coming, but they knew that where they had come from had reached an end.
Yep.
Yeah, it was just on the tail end of the hippie movement. Led Zeppelin was still like killing it. Music was amazing. There were deals being done, backroom deals, mainly around the petrodollar, the U.S. dollar system. 1971, President Nixon took the U.S. dollar fully off the gold standard, and that set off a whole chain of events, which was really rough to start with. Intense inflation, but then we entered into this kind of somewhat golden era from 1980 to 2020, really, with gradually falling interest rates, lower lows, lower highs, and doubling of asset prices every 7 to 10 years. And we kind of still have that right now, but it feels like we're in this new zone where we're a little bit bewildered and wondered, where we're wondering what is coming next, because we can kind of see that there's an end of all these things, but we don't yet know what the beginning really looks like. And it's good for markets that there's this machine which is attracting all the capital, and hopefully that spills over, keeps some stability going. But everywhere you look, it's like there is this finiteness, or there is a turning of a cycle, right? And I know it's nuts, but it is true that cycles kind of keep on happening, and history doesn't repeat, but it rhymes.
Yep.
And gold, great example. Does it actually act as a good inflation hedge? One of the things I've been considering lately when I look at 1977 in particular is, does gold actually have the power to predict the future? Can I actually say, hey, inflation battle being lost, and therefore when we look at today, is gold telling us that the inflation battle has been lost when it's reaching all-time highs as well? So there's these parallels in the 1970s. I don't know whether it's legit or not, but it's interesting in terms of having a mental framework. Do you have any kind of thoughts on where we're at relative to other times in history?
Yeah, look, I think that from a market's perspective, we are. I actually agree with the 1970s as an interesting backdrop. I mean, you look at what happened in Europe through that time, where, I mean, many European countries had rioting in the streets through there as well. It is a really, really interesting one. I think the big difference from my perspective versus kind of, so when I think about 2007, I think about 2000 and I think about 2007, I think about kind of 99, some of those previous big crashes that kind of we remember so clearly. I mean, 99, because we had a set of, in 2000, we had a set of companies that were based on promises, not based on reality. And so we clearly don't have that right now. We've got these companies are driving and delivering higher numbers than have ever been delivered before. 2007, look, we had an economy built on leverage. And so it was a leverage structure which caused that crash. And so that was where we kind of went, okay, cool, we're not there today. We've got way too much leverage at the government levels and way higher levels of leverage than we've ever had there. But we don't have that at the personal level. Or we do have it at the personal levels, that's a lie. But we don't so much have it at the corporate level. So I think there's that there. Then we go back to the 87 crash, or the mid-90s. That was an Asian crisis. It was kind of US dollar related. We've kind of learned our lessons from that. 87, that was a much shorter one. But so the only piece where I can kind of come back together and put a combination of the inflation plus the social unrest plus actually unrest in the Middle East, you're probably right. It is the 1970s. I'm just struggling to think how we manifest to kind of that world. And then I'm also on the fly trying to figure out in my head, it actually wasn't that bad a decade for investors either. I'm pretty sure most investors did pretty well through the 1970s. I think the crisis was in 74, I think again in 82, 83. But I think as investors in the equity markets, you did pretty well through that period as well, despite the social change that happened.
Yeah, adjusted for inflation, maybe not so much, right? Like inflation was absolutely insane. From 1970 to 1974, I think when I was looking into this, $1 in 1970 was worth 68 cents in 1974, something like that. Could be wrong.
Yep. No, that sounds about right, because it was running in mid-teens for a while.
Yeah. Well, there's a really good resource that, oh man, I can't remember what it's called, but it was actually a New Zealand resource where you could actually put in the date range. I think it was Stats New Zealand. Hey, look at that, Stats New Zealand. This amazing new tool. It's been around forever. But tell me about this wacky theory, right? So I think of the financial system basically as a gigantic Ponzi scheme, which I think is fair to say. And at a level, it's not technically true because there is no grandmaster of the Ponzi scheme, which there kind of has to be for it to technically be. So it is probably more accurately a pyramid scheme now that I think this through. Yep. And so the success of investors depends on new investors coming on board and putting more money in so that the pre-existing investors have inflated asset values. To a certain extent, that's true. And it's the free market and it's evolution, survival of the fittest. Good companies do better over time, right? But underneath all of this, the denominator in all of our wealth is always the dollar. So when the dollar is being interfered with, and by interfered, I just mean when power is given to governments and central banks to effectively create new currency using complicated shell games that most people don't understand, then what happens over time is that all assets look more expensive than what they really are. It's a bit of a distorted view. So over time, you kind of have these pockets of bulging credit creation that pop up all over the system. For example, right now, 34.6 trillion public debt in the US, which is a rather large number. It only hit this high briefly just after the pandemic in 2020, but this is a record high in terms of the US public debt.
Yep.
In New Zealand, we're probably going the same way, but it seems like it takes a turn where it's public debt and then it's private debt. It's asset prices, and then it's the goods that we need and consume. It's like the prices are never static when the money is being interfered with, but it's never a consistent experience when you're stolen from. It's gradual and it's lumpy. And right now it feels like that new credit creation is probably hanging around the public sector a little bit more. And so I wonder how much of investing is just kind of just understanding that is the game that we play. And that's why no matter what's happening in the world right now, and if there's a good news day or a bad news day, it kind of doesn't matter because that credit creation machine is always running to some extent. And it's the same soup and different spoons when you invest sometimes, these different assets that we invest in, right? But effectively, there's more and more soup getting filled up. And so we don't really need to overthink it again. I know we always come back to this circle every time we have a chat, right? Where dig a little bit deeper, intellectualize a little bit, and then come back down to reality that over the long term, markets always go up. Therefore, the faster you get in and the more you put in, the better you're going to, so nothing's really changed there, has it?
No, nothing at all. And even, well, the other big thing that we thought had changed was the Fed put, right? So coming back to your point on creation, 6 months ago, the prevailing narrative was the Fed put's no longer there and the Fed's going to do kind of everything it can to beat inflation. Yet at the moment, we've got a world where inflation rates are staying higher, unemployment's staying lower, and the Fed is still adamant that the next move is down on interest rates, not even willing to entertain a look up. So you're 100% right. It is, the system is set up to succeed. But
it is.
Is there a problem with that? I guess is my challenge back to you. And if the system is set up to succeed, and we kind of know that it's set up to succeed, don't we just jump on board?
Yeah. Well, that's the thing. We can either rage against that machine or we can use it for our benefit, right? It's a funny one. Like every time I have the conversation with people with property, not in the current market when property is booming again and people want to pile into property because it looks like it's the easiest thing ever. It's the question always comes up. Surely it can't continually double in value every 10 years, right? At some stage it has to break. And yeah, I guess in theory there is a problem with it, right? It has to be finite. But I guess when you're on an exponential curve, it's really hard to get a gauge of that. Like it feels almost impossible to get
Yep.
off of this doubling. So I guess if that's true in property, it's true in markets, it's true with the credit creation process. It always has to be increasing, but at some stage, people are going to revolt against that, and that concerns me because that creates all sorts of instability, which then brings us back to the question of, is it different this time and our market's really heading for a crash? Because it seems like still everything is converging.
Yeah, I mean, the reason why I'm gonna take the negative and say no on the crash is because I struggle to see the catalyst. Will they take a dip? Yes, they will. I mean, would I be surprised if they drop 10, 15% at some point in the next couple of months when we get some negative news? Markets are skittish at the moment, so I'd say that's highly, highly likely. But is there anything that I can see that you go, actually, yeah, I'm really struggling because I think the strength of these companies and the lack of regulatory pressure on them is so great. I mean, I just had a quick 30-second look, and I mean, you asked the question around what does this time frame remind you of? To be fair, I'd probably go all the way back to the very early 1900s or late 1800s in the time of the monopolies, where we had the likes of the Standard Oils and those kind of people, right? Are we back into that world?
Right. Okay.
We
I get
know
it.
how
Like
that ended.
technology, right? Yeah. Because that would have been railway, right? And oil and all that sort of
It was a
stuff. Yeah.
combination of railways. I mean, that was the last of the big technological that was coming towards the end of the Industrial Revolution where that all happened, right? And so, we do know how that one ended. And that one ended in World War One. But again, not a bad period for investors either. So it's a really, really interesting one. But I think to me, it all comes back to, because we think it's bad for the economy, because we think it's bad for consumers, and we think it's bad for humankind, does that mean it's bad for markets? Not necessarily, and often it's actually the opposite.
Yeah, which is always brings you back down to, hey, the smartest thing to do, the smartest response is just to keep on investing if you can.
If you believe the game is rigged to kind of keep going up, and that the systems are there to make sure it keeps going up, what's the point in fighting it? Just jump on board.
Yeah, that's right. So the money's broken, so what? Right?
Exactly.
That's kind of the idea. Interesting.
I mean, this is me being that, what's the word? I guess the finance person that kind of, look, it is what it is. It's kind of my job is to help my clients kind of make the most out of it versus kind of do something a little bit different. And I get it's not necessarily the calmest or the prettiest of ways of being, but it is what it is.
Yeah, no, it is. And I think people probably should appreciate that when you hear people like us talking about it, we all have a vested interest in the status quo persisting, right? Because that's kind of how we get paid. So there is that we have to kind of disclose and put it out there. But at the same time, it's like there's a certain point where you can kind of grow up to a certain degree and actually critique your own biases. And that's where we're at, right? Where we're just being honest with the thoughts
and people should, right? I mean, one of the reasons why we are in the political situation that we are in is because we have all walk our way through all of this, right? And look, I wish I was a better person and took the view that actually I want to change it and I want to make it better and improve things, but I'm not.
Yeah. That's good. Okay, so there's a bigger conversation that we need to have maybe next week around around AI, I think.
Yeah, definitely.
Because you mentioned the term sleepwalking, and I think since the release and the big hoopla with OpenAI and ChatGPT a while back, it kind of went away in most people's consciousness. I've been fiddling around with it a lot and watching things progress, and just like this morning, learning about ChatGPT 4.0, I guess is what they're calling it. An unbelievable quantum leap in what ChatGPT will do, where you can use your phone to scan around the room. It will have a conversation with you, and it will tell you what it's seeing. It will describe to you what it's seeing in real time. It will help your kid solve maths problems. There's huge advancements happening at the moment.
So I'm fascinated on that, because I guess one of my biggest concerns on a lot of that stuff is, what does it actually all mean for what does it mean for education, and what does it mean for development and all of those things, right? I remember back when I was a young graduate, in my investment banking days, one of the most painful things we used to do was comps. We did comparables. But we kind of trying to figure out what's the valuation of a company and how does that compare to the 5 or 6 others that are in a similar sector. We used to have to spend days trawling through balance sheets, understanding, and it really taught you exactly what makes up a balance sheet, really good on valuation, all of those core skill sets that are important. Today, that same graduate just goes straight to FactSet and outspits the number 5 seconds later. And I guess everything that you're saying, if AI is going to do all of that, what does that actually mean for our kids and them learning how to do stuff? And that's why I find that a fascinating conversation.
Oh yeah, it is. And I just feel though that I think we have been asleep at the wheel to a certain extent. And like, you just take NVIDIA, for example. I've been skeptical of the share price around that. Same thing with the Magnificent Seven. I just struggle to understand that. It's the penny's starting to drop a little bit more when you actually can see what this impact is. But you're right. Like, I think the biggest risk is that the next generation of workers are going to be perfecters at the art of mimicry, and they won't actually understand how things really work. They'll just know that things do work. And I think there's a massive opportunity that's lost in that. And so I think, let's maybe reconvene next week and have a bit of a deeper dive in that one, because that's probably the core of where new wealth will be built from, will be in something around that, where effectively it's just data.
Right. It's going to be new wealth. It's going to be, it's going to be a very different world where we land.
Yeah. It's cool. It's exciting though.
Exactly.
It's exciting. Yeah. Like in the 1970s, it was just all brown and orange. And now it's like so much better. We got so many more
but you got to remember, right? Who were the Magnificent Five in the 1970s? It was IBM. It was a telecoms company. It actually wasn't all that different, to be perfectly honest. It was all of these big, very large companies that were going to change the world.
It was technology. It was still technology, wasn't it?
It was still technology, right? And I mean, the definition of technology has changed. So back then it was telco was technology, hardware, computers were technology, whereas now all of that kind of stuff is utility / kind of commodity. Whereas technology is what you're doing with the data layer that sits on top of it. And increasingly, the next layer is how you can efficiently process that data to come up with, because even you think about a Facebook business model, right? That was all about access to data and pretty crude ways of using that data. And actually, well, to be blunt, it was using that data for advertising purposes. The next model is going to be, how do you use that data to enrich people's lives and make their lives easier?
Yeah, and I think that's the next evolution of the internet as well, where it's the internet of value rather than the internet of information. And then hopefully the users can participate in that value more. So again, I think it's interesting. It's just another manifestation of the rollout of technology through time, which makes everything cheaper. And that effectively creates the ability to absorb the inflation, which again brings us back to credit creation. Okay, this is good, but we're going to be here all day. So I think maybe we should finish up on this one. All right, awesome. Well, thank you for that chat. Len, look at that. We didn't even think we had anything to talk about today. So there you go.
Okay, well, thanks, Darcy. And we'll chat next week, AI, and maybe we'll have some new news to talk about.
I guarantee it. Yeah, awesome.
Okay, thank you.
Cheers.